Good afternoon. In today's class, we are going to see how we can value securities. Good afternoon. In today's class, let's learn how we can value securities. Now, before I teach you how we could value securities, let me tell you what I mean when I say securities. When we say securities, we are actually referring to the various securities that could be issued by a company with the intention of raising capital. So, that would include equity share capital, preference share capital, debt instruments, which as you know would include debentures, bonds and long-term loans. So, to start with, let's see how we can value debt instruments, namely bonds. Now, what is the meaning of a debt instrument? When I say a debt instrument, I actually refer to an instrument which has been floated or issued by the company with the intention of raising money from creditors. And the annual return which would be paid by the company to these creditors could be called as interest, or in better parlance we could call it as coupon rate. So let's go about seeing how to value these debt instruments. To start with, let's see how we could value bonds. As I told you earlier, bond is a debt instrument on which the investor would be expecting a return which we call as interest or coupon rate. To take a hypothetical example, let us assume the company is willing to give a coupon rate of 10%, and I as an investor, I am also expecting a coupon rate of 10%, or rather my required rate of return is 10%. So there is perfect synchronization between what the company wants to pay a creditor and what the creditor is expecting from the company. Of course, there could be other instances where the company is willing to give only 10%, but the investor is requiring a return of 12%. Yet there could be another situation where the company is coming forward to pay a coupon rate of 10%, but the investor is expecting a minimum rate of 8%. So we have three situations. One, where the coupon rate is equal to the required rate of return. Two, where the coupon rate is lesser than the required rate of return. And thirdly, where the coupon rate is more than the required rate of return. So let's see how we are to value the bond under these three situations. I repeat, one, where the coupon rate is equal to the required rate of return. Two, where the coupon rate is lesser than the required rate of return, and the third one where the coupon rate is more than what the investor expects from the company. I think we all know the concept of present value. What do you mean by present value? See, I am willing to invest in a bond, which means I pay 100 rupees today and the company has promised me a coupon rate of 10%. Let me assume the lifetime of the bond is 5 years. So, if I have to chalk out what would be the return on this bond, it will be like this. Every year for a period of 5 years, I will be getting the interest, which will be 10% of 100 rupees. So that makes it 10 rupees. And apart from that, at the end of the 5th year, as per the terms of the contract signed between the bondholders and the company will be returning the money. So in the 5th year, by the end of the 5th year, apart from the coupon that I would be receiving, I would also get the principal amount which I have invested in the bond. So for the first year it will be just 10 rupees, second year 10 rupees, third year 10 rupees, fourth year 10 rupees. But in the 5th year, it is not going to be only 10 rupees, it is going to be 10 rupees plus 100 rupees. So that will make it 110. Now, I go back to my example. Company is giving me a coupon rate of 10%. I expect 10%. Second situation, company is giving me a coupon rate of 10%. I expect 12%. Third situation, company is giving me a coupon rate of 10%, but my expectation is 8%. Now, making use of this concept of present value, I can find out what will be the value of the bond. Now, what is the need for me to calculate this value of the bond? As an investor, I expect some return when I make an investment. So, with the help of these three situations, I will be able to help you to understand what will be the initial amount, what will be the amount the investor is willing to invest towards purchasing the particular bond. In case I want 10% and the company is giving me 10%, very well and good. If the par value of the bond is 100 rupees, I would be more than happy to pay 100 rupees and buy the bond. On the other hand, company is giving me 10%, but my expectation is 12%. So it goes without saying, I am not getting what I want, and hence to buy the bond today, maybe I will not be willing to pay 100 rupees. I will be willing to pay something lesser than that, because I hope that will compensate me for the difference in return which I will not be getting from the company. In the third situation, company is willing to give me a coupon rate of 10%, but I expect only 8%. So here, when the company tells me, look, I am willing to give you the bond at 100 rupees, I would be more than happy to buy it. Or in other words, I can also go one step ahead and say, maybe I will be willing to pay more than 100 rupees to buy it, because I am going to get more than what I expect over a period of 5 years from this company. Now, keeping in mind these three hypothetical situations, I am going to teach you what is going to be, or what we would call as the bond valuation theorems. There are three bond valuation theorems. I go back again to the same simple example. The first situation where the coupon rate is equal to the required rate of return. So first bond valuation theorem tells us where the coupon rate is equal to the required rate of return, the par value of the bond would be equal to the present value. So there will be no difference between what the company wants from me as an investor and what I am willing to pay the company as an investor. So when the coupon rate is equal to the required rate of return, the par value of the bond would be equal to the present value. In the second situation, company is willing to give me only 10%, but I require a return of 12%. Here, the bond valuation theorem would be like this. Where the coupon rate is lower than the required rate of return, the par value of the bond, you will find, is higher than the present value of the bond. I am making a sacrifice. I want 12%, but the company is giving me only 10%. So, in order to compensate me for the sacrifice that I make towards the return on the bond, I would like to pay lesser today to procure the bond. The third situation, or the third bond valuation theorem, says this. Where the coupon rate is more than the required rate of return, the par value of the bond will be the par value of the bond will be lesser than the present value. So I am willing to pay more today to buy that bond because I want only 10%, but the company, I want only 8%, but the company is willing to give me 10%. So I am more than happy to receive that higher returns, and hence I am willing to pay more today to procure the bond. So I go back to the three bond valuation theorems. First one which says where the coupon rate is equal to the required rate of return, par value of the bond will be equal to the present value of the bond. Where the coupon rate is lower than the required rate of return, the par value of the bond will be lesser than the present value. And the third one, where the coupon rate is more than the required rate of return, the par value of the bond will be higher than the present value. With the help of a numerical example, let us learn the concept once again. So let me assume there is a bond and the par value of this bond is equal to rupees 100, and number of years to maturity which we take to be N is 5 years. Next, I assume that the coupon rate is equal to 10%, whereas I will assume there are three required rates of return and I take them to be 12%, 10% and 8%. So here is a situation where company is giving me 10%, but I want 12%. Here company is giving me 10%, I also need 10%, and the third situation, company is giving me a coupon of 10%, but I need a return of only 8%. Now how do we calculate the present value? As you all know, we have the present value tables, with the help of which we will be able to arrive at the present value of the bond under these three hypothetical situations. So I take the first situation where the coupon rate is lesser than the required rate of return. For example, the coupon rate is only 10%, but my required rate of return is 12%. Now I will be able to prove to you that as an investor, I will not be willing to pay this 100 rupees, but I will be willing to pay only lesser. So what will be the return on this bond? If I have to teach you what will be the return on this bond, as I told you, for the years 1 to 5, my coupon that I will be receiving, or the interest that I will be receiving on this bond will be rupees 10. But for the 6th year, apart from this, so 1 to 4 it will be 10 rupees, and for the 5th year, apart from this 10 rupees, I will also be getting another 100 rupees, so that will make it 110. Now how do I calculate the present value? To calculate the present value, I will be making use of the present value tables. I have a copy of that, so I will be referring to that, and with the help of that, I will be able to arrive at the present value of this bond. So it is like this: present value of bond will be equal to I, that is the interest that I will be getting. For how many years am I going to get it? I am going to get this for how many years? I am going to get this for a period of 5 years. Plus I will also be getting the principal as at the end of the 5th year. So this will also be to the power of 5. Now what is the amount of interest that I am getting? That is 10 rupees divided by, what is my required rate of return? It is 12% to the power of 5 plus rupees 100 divided by 1 plus 0.12 to the power of 5. Now this can be rewritten as rupees 10 into PVIFA. Why do I use the discount factor from the PVIFA table? This is a constant value. As you can see, for a period of 5 years, every year the return is going to be 10 rupees. So I take this to be a case of even cash inflows plus rupees 100 into PVIF. Now what is the year that I will be using here? It will be 5 years. What will be the discount rate? The required rate of return will be the discount rate, and here it will be plus rupees 100 into PVIF, and here the discount rate, the number of years will be 5 years, and the discount rate will be 12%. So if I have to give you the actual answer for this, let me refer to the PVIFA table. The PVIFA table tells me for 5 years at 12%, the discount factor will be so that will be rupees 10 into 3.605 plus rupees 100. Now I have to pick up this discount factor from PVIF table. How do I do that? I will have to travel along the 5-year line and pick up the discount factor that is given under 12%, as you already know about it. So I find out what is the discount factor. So for the 5th year, the discount factor as given under 12% is coming to into 0.567. Now let me multiply this. It will be about 36.05 plus it will be 56.70. So 36.05 plus 56.7057 12. So I will be willing to pay only about 93 rupees to procure this bond. Why is it so? Company wants me to pay 100 rupees, but I am not willing to pay 100 rupees because To start with, I am making a sacrifice. What is the sacrifice? The return I expect is 12%, but the return which the company is paying me is only 10%. Hence, to compensate this sacrifice that I am making, I will be willing to pay a lesser amount towards the procurement of this bond. So, I think we have seen one of the bond theorems, we have proved one of the bond theorem which says when the coupon rate is lesser than the required rate of return, the par value of the bond will be higher and the present value of the bond will be lesser. Now let's move on to the second bond valuation theorem, where I told you where the coupon rate is equal to the required rate of return. What is the theory that we saw? I told you when the coupon rate is equal to the required rate of return, the par value of the bond will be equal to the present value. Come on, let's do that. To do that, I am going to maintain the same details as I have given here. The only thing that I will be changing will be this R. What is this R? This R refers to the required rate of return. So it will be, let me rewrite this equation so that there is no confusion. So when I rewrite it, this will be equal to rupees 10 into PVIFA at 10% for 5 years plus rupees 100 into PVIF at 10% for 5 years. Now when I do this, this is going to be rupees 10. Now the discount factor at 10% for 5 years is 3.791, and here it will be 100 into PVIF at 10% for 5 years will be 0.621. Now find out, this will come to rupees 37.91 and this will be 62.10. So that gives you an answer which is almost equal to rupees 100. So we have proved the second bond valuation theorem, which says when the coupon rate is equal to the required rate of return, the par value of the bond will be equal to the present value. Now that takes us to the last bond valuation theorem that we have to see, where I have to show you that where the coupon rate is more than the required rate of return, what will happen to the present value? Come on, let us replace this R. What will be this R now? This R will become, so this R will become, so this R plus 1 plus R to the power of 5. So this R will become, it will become 8%, and here also it will be 8%. So let's rework and find out what is going to be the value of this bond. We should get an answer which is more than 100. So this will be rupees 10 into, let me find out what is the PVIFA value at 8% for 5 years. For this I have to go to the PVIFA table, travel along the 5-year line and find out the rate that comes under 8%. So that is coming to 3.993 plus rupees 100 into, now I go back to the other table which is the PVIFA table, and I have to pick up the figure that is given against 5 years under 8%, and that is coming to 1, 2, 3, 4. That will come to 0.681. So let's find out. So this will be rupees 39.93 and this is going to be rupees 68.10. So that will be 39 plus 68. So that is giving me about a little more than rupees 107. So I have proved the third bond valuation theorem, which tells you when the coupon rate is greater than the required rate of return, the par value of the bond will be less and the present value of the bond will be higher. This is because the investor is willing to pay more today to buy this bond because he believes he is going to benefit since his required rate of return is only 8%, but the company is kind enough or is willing to give him a return of 10%. I hope you have understood it. Now let's move on to seeing how do we value preference shares. Now, valuation of preference shares will be almost similar to what I have taught you under bonds, because both these are considered to be fixed return bearing securities, where, as you know, the return will be given to you at the time of buying it. You will get to know what is the return you can expect from the company when you buy the bond or when you buy a preference share. So I repeat again, preference share valuation is similar to what we have done in the case of bonds. For example, if I buy a preference share and I am willing to pay and the par value is rupees 100 and the dividend that is going to be paid on this is going to be 13% and the number of years is going to be 7 years, keeping this information and my required rate of return, let me assume, is 12%, I can find out what will be the present value of the bond following the same methodology that I have taught you with respect to valuation of bonds. So, valuation of preference shares is almost identical to valuation of bonds. And there too, you have the dividend that is paid by the company, and as an investor you have your own expectations towards the dividend that you will be expecting from the company. So keeping these two, that is what the company is willing to give you in the form of dividend and what you expect as an investor, you can very easily find out what is the present value. What do we mean by this present value? Present value will refer to the value that I am willing to pay today to buy this bond. Now, when we move on to valuation of equity shares, it is a very complicated affair and it is not that easy as compared to valuation of bonds or valuation of preference shares. Why is it so? It is so because when I buy an equity share, the company does not tell me what will be the rate of return I can expect on it. The company does not give me details about what will be the dividend it is going to pay me, what will be the EPS that it will be making, because all that will depend upon the future prospects of the company. So it's a very complicated affair, and hence, since I do not know what is the rate of return that I can expect, it becomes a very complicated affair. Nevertheless, there are various approaches that we can make use of, with the help of which we can calculate what is the valuation of, how to value an equity share. Now, before I move on to explaining what are the methods, let me tell you some distinct feature of a preference share. A preference share is always called as a hybrid security. Hybrid security. The reason as to why a preference share is called as a hybrid security is because this preference share enjoys one common characteristics with a bond and another common characteristic with a preference share. Now, what is a common characteristic between a preference share and a bond? Let's see that first. The common characteristic between a preference share and a bond is that both these securities have fixed return. When you buy the security, when you are investing in the security, at the time of investing itself, you will be told what will be the return that you can expect on it. But when it comes to an equity share, as I have already told you, it is not like that, and it will depend upon the future earnings of the company. Next, the common feature between a preference share and a equity share. Both these types of shares, you will find, do not guarantee you a return. On the other hand, I can put it this way, payment of interest or coupon on a bond is is a statutory requirement, whereas payment of dividend either on a preference share or on an equity share is not a statutory requirement. As a result, you will find preference shares and equity shares are taken to be same with respect to payment of dividend. Only when the company makes a profit and only when the board feels fit or they do not feel that they will have to retain the money, dividends will be paid to the equity shareholders. So that's it as far as valuation of securities are concerned. Thank you.